Current account deficit for the January to March quarter has fallen very sharply and is now at merely $300 million. This translates to merely 0.1% of the overall GDP. Latha Venkatesh is here to put this into perspective. Latha, what resulted in the sharp fall?
One saw it coming, of course. The current account deficit has actually narrowed for the quarter, Jan-March quarter, to as little as $300 million. That's what 0.1% of the GDP. A lot of economists had expected it would actually be a surplus. This is largely because the trade deficit had already fallen. The trade deficit for the Jan-March quarter was about $24 billion compared to about $34 billion the year ago period. Now, while the trade is a deficit, India exports a lot of services, largely software services. And the other way in which the current account deficit is bridged is because of Indians living abroad and sending money, which is called private transfers. Now, private transfers has fallen a bit to 15.1 billion compared to about 16 billion year ago, because the reduction in the Gulf prosperity has also meant remittances have fallen a bit. But nevertheless, because the trade deficit has shrunk all the way to 24 billion, it is easily matched by software exports and by Indians sending money home, leading to a current account deficit that is negligible. Even the other important, that's the current. If you looked at the capital account as well, there are some positives. Net foreign direct investment is 8.8 billion, a fairly good number compared to our older run rate, but slightly less than the year ago number of 9.3 billion. Not a very big difference, but a small difference. Portfolio investments, however, were negative in the Jan-March quarter. If you remember, that was the time when there was the Chinese devaluation threat in January, as well as recessionary fears in the US. So the portfolio investment recorded an outflow of 1.5 billion. But because the FDI was very good and non-resident Indian deposits increased, you actually had a foreign exchange inflow and reserves increased by $3.3 billion in the Jan-March quarter. For the full year itself, that is FY16, the current account deficit has narrowed to 1.1% of the GDP compared to 1.8% in the year ago period. And chances are that this year as well, we may clock a current account deficit as low as 1% of the GDP.
All right, Latha, thanks for joining in with those details.